Welcome to today's episode, where we take a deep dive into NVIDIA's latest quarterly performance. At Konsults.ai, we approach this analysis through a rigorous Big Four consulting lens, bringing you not just raw numbers, but strategic insights. Our objective is to unpack NVDA's financial health, working capital efficiency, margin dynamics, strategic risks, and their competitive positioning in the semiconductor and AI space. Expect a premium, data-driven briefing, the kind of perspective you'd find on Bloomberg TV, paired with McKinsey-grade rigor.
Absolutely, Shekhar. Our focus will be on granular quarterly data, tracking revenue growth, margin shifts, and cash flow trends, to identify emerging patterns and inflection points that signal regime changes in NVIDIA's business model. This approach allows us to translate complex financials into clear, actionable intelligence that goes beyond surface-level reporting.
And from my side, I'll challenge those insights with a practical lens, asking what they really mean for investors and company leadership navigating today's volatile tech landscape. It's one thing to know the numbers, it's another to understand the sustainability of growth and the real risks behind those figures. Together, we'll deliver a comprehensive, nuanced view of NVIDIA's latest quarter and what it signals for the road ahead.
Let's start with the top line. NVIDIA reported revenue of $16.3 billion this quarter, which is a 12% increase quarter over quarter and a robust 35% growth year over year. This continues the strong growth trajectory we've seen over the past several quarters, driven primarily by their data center segment.
Right, Shekhar. When you break down that revenue growth, the data center business alone grew 40% year over year, now constituting roughly 60% of total revenue. That's a clear inflection point, reflecting NVIDIA's strategic shift from primarily gaming-focused revenues to AI and enterprise workloads. Meanwhile, gaming revenues showed more modest growth of 5% quarter over quarter and appear to be stabilizing after some volatility last year.
From a CFO perspective, those top-line numbers look impressive, but I'm always cautious about the quality of growth. Do we know if that 12% quarter-over-quarter revenue gain is driven by strong end-market demand or inventory adjustments upstream in the supply chain?
Good point, Raj. The financials show gross margin expanded to 66.5%, up 100 basis points quarter over quarter, indicating pricing power and operational leverage. Net income was $5.1 billion, up 15% sequentially and 40% year over year, which suggests demand strength rather than just channel stuffing. EPS landed at $3.15, up from $2.75 last quarter.
Adding to that, operating cash flow increased by 8% to $5.7 billion, reflecting solid cash conversion and working capital management. However, it's worth noting that days inventory outstanding ticked up slightly this quarter, hinting at cautious stocking by NVIDIA or its customers, possibly preparing for anticipated demand surges in AI infrastructure.
That inventory rise could be a flag. We've seen tech companies build inventory ahead of product launches or supply chain uncertainties before. It raises the question of how sustainable the margin expansion is if there's any potential for future write-downs or discounting.
Certainly, inventory trends deserve monitoring, but given NVIDIA's dominant position in AI accelerators and their recent investments in next-gen GPU architectures, this buildup likely reflects strategic positioning rather than distress. The 66.5% gross margin is also among the highest in the semiconductor industry, reinforcing their premium pricing and cost structure efficiencies.
From a pattern recognition standpoint, the EPS growth rate is accelerating faster than revenue growth, which implies margin expansion and operational leverage kicking in. That's consistent with the shift towards higher-value AI workloads, where NVIDIA commands significant pricing power versus competitors.
I agree, the financial trajectory looks strong. But as an investor, I'd want to see how NVIDIA manages potential macro headwinds, interest rates, geopolitical risks impacting supply chain, and competitor pressure from AMD and Intel. Sustaining this growth will require continued innovation and market execution.
Absolutely, Raj. To summarize, NVIDIA's quarterly financial health is robust. Strong revenue growth, driven by AI and data center demand, expanding margins, and solid cash flow generation. The numbers reflect a business model successfully transitioning into a new growth regime, with fundamentals supporting long-term value creation.
Looking closely at the quarterly data, one clear inflection point is NVIDIA's shift in revenue composition. The data center segment now accounts for about 60% of total revenue, up from roughly 50% just a year ago. This signals a structural regime change, moving away from the traditional gaming dependency toward AI and enterprise workloads, which carry higher margins and longer product life cycles.
That's an important shift, Priya. But from a CFO's perspective, I'd want to probe how durable this is. The AI-driven demand surge is real, but it's also subject to cyclical tech spending and macroeconomic headwinds. If enterprises pull back on infrastructure investments, or if there's any hiccup in supply chains, that growth could stall quickly.
Raj, you raise a valid point. However, I'd frame this shift as a fundamental repositioning of NVIDIA's business model. The move into AI accelerators and data center solutions isn't just a temporary revenue bump. It reflects a regime change in the semiconductor industry itself, driven by emerging technology trends. NVIDIA's investments in next-generation GPU architectures and AI software stack reinforce this long-term pivot.
Adding to that, we see another inflection point in inventory and supply chain dynamics. Days inventory outstanding ticked up slightly this quarter, which could indicate cautious stocking ahead of anticipated demand surges in AI infrastructure. Meanwhile, geopolitical uncertainties and macroeconomic volatility are influencing supply chain lead times and costs, suggesting a regime where supply constraints could intermittently affect delivery and margins.
Right. And that inventory build could be a double-edged sword. On one hand, it supports readiness for demand spikes. On the other, it raises questions about potential write-down risks if end-market demand softens. Also, supply chain disruptions have historically pressured margins in the semiconductor space. So, investors should be wary of volatility in working capital and cost structures as NVIDIA navigates this new regime.
Certainly, monitoring supply chain and inventory trends is crucial. Yet, NVIDIA's scale and vertical integration give it a competitive advantage in managing these disruptions compared to peers. Coupled with strong pricing power, as reflected in expanding gross margins, these inflection points support a strategic opportunity rather than a vulnerability. Overall, the data indicates NVIDIA is navigating a new growth regime shaped by AI acceleration and enterprise demand, which positions it well despite near-term risks.
Let's start with NVIDIA's working capital metrics. Days Sales Outstanding, or DSO, remained stable at 40 days this quarter, reflecting consistent collections. Days Inventory Outstanding, DIO, ticked up slightly to 75 days from 70 last quarter, indicating a moderate build in inventory. Days Payable Outstanding, DPO, held steady at 60 days, so overall the cash conversion cycle lengthened marginally due to the inventory increase.
That incremental rise in DIO aligns with NVIDIA's operational strategy to buffer supply chain risks, especially given the complex chip manufacturing lead times. Compared to peers like AMD, whose DIO is closer to 90 days, and Intel at around 80 days, NVIDIA maintains relatively lean inventory. Their DSO of 40 days also reflects efficient receivables management, outperforming the semiconductor industry average, which often runs closer to 50 days.
From a CFO standpoint, the slight inventory increase is a double-edged sword. On one hand, it's prudent to stock up ahead of expected AI infrastructure demand surges. On the other, any overbuild risks tying up cash and potential write-downs if demand softens. The steady DPO at 60 days is healthy, but also means NVIDIA isn't stretching payables excessively, which preserves supplier relationships, but limits short-term cash flow flexibility.
Exactly, Raj. The resulting cash conversion cycle, DSO plus DIO minus DPO, came in at 55 days this quarter, up from 50 days previously. While a 5-day increase isn't alarming, it signals a slight dip in liquidity efficiency. However, This is consistent with the company's positioning to support ramp-up in AI and data center workloads, which require higher inventory buffers due to longer manufacturing cycles and component complexity.
This working capital profile underscores NVIDIA's nuanced supply chain approach. They're balancing just-in-time principles with strategic stocking to mitigate geopolitical and logistics risks. Importantly, their gross margin expansion alongside this inventory increase suggests they are not discounting to clear stock, but rather building deliberate capacity. Compared to Intel, which saw a widening cash conversion cycle to nearly 70 days last quarter, NVIDIA's disciplined working capital management is a competitive advantage.
Agreed, Shekhar. But investors should watch these trends closely. Working capital inefficiencies can quickly erode cash flow if demand turns or supply chains destabilize. NVIDIA's ability to maintain healthy DSO and DPO while managing inventory will be critical to sustaining liquidity and funding ongoing R&D and capital expenditures without raising external capital. Overall, the metrics look solid now, but execution risks remain real in this volatile semiconductor environment.
Let's turn to margin analysis. NVIDIA reported a gross margin of 66.5% this quarter, which is up 100 basis points sequentially. Their operating margin came in at a strong 38%, reflecting both scale and efficiency gains, while net profit margins stood at 31.3%. These figures position NVIDIA at the top end of semiconductor industry profitability benchmarks.
Breaking this down further, cost of goods sold grew modestly relative to revenue, thanks to better supply chain leverage and component sourcing. R&D expenses increased by 10% year over year, now representing about 21% of revenue, highlighting NVIDIA's commitment to innovation, particularly in AI and GPU architectures. Meanwhile, SG&A expenses remain stable at roughly 13% of revenue, demonstrating disciplined cost control even as they scale.
From a CFO standpoint, these margin expansions are impressive, but not without challenges. Maintaining operating margins near 40% requires tight control over both fixed and variable costs. Rising R&D spend is necessary, but can pressure short-term profitability. Also, given supply chain volatility and potential pricing pressure from AMD and Intel, sustaining these margins will require careful balancing of investment and operational rigor.
Comparatively, AMD's gross margin typically runs around 45%, with operating margins in the low 20s, while Intel's gross margin hovers near 55%, with operating margins under 30%. NVIDIA's superior margin profile reflects economies of scale, a premium product mix, and a strong pricing moat in AI workloads. Their vertical integration and software ecosystem also contribute to this profitability edge.
It's also worth noting that NVIDIA's margin resilience is partly due to the shift toward higher-margin data center and AI products, which offset gaming's more cyclical and lower-margin nature. The incremental R&D investment is focused on maintaining this technological edge, which is critical for sustaining margins as competition intensifies. SG&A discipline further supports net margin stability despite scaling challenges.
I agree with both of you, but investors and management alike should stay vigilant. The semiconductor industry is notorious for margin swings, driven by product cycles and external shocks. NVIDIA's margin leadership is a strategic asset, but continued innovation, cost discipline, and supply chain agility will be essential to defend it. Any misstep could quickly erode profitability, so margin management remains a core challenge moving forward.
When we look at NVIDIA's strategic landscape, the foremost risks are intensifying competition from AMD and Intel, ongoing supply chain vulnerabilities, particularly around semiconductor fabrication capacity, and increasing regulatory scrutiny in key markets like China and the US. At the same time, we see compelling opportunities in AI acceleration, data center expansion, automotive semiconductors, and edge computing, areas where NVIDIA's technology leadership can drive long-term growth.
Adding to that, regulatory pressures are not just about tariffs or export controls. There's rising scrutiny on data privacy and AI governance, that could impact NVIDIA's AI product deployments globally. On the opportunity side, automotive semiconductors are gaining traction as NVIDIA pushes into autonomous driving, with that market projected to grow at a CAGR of over 20%. Edge computing is another nascent area where low-latency AI inference chips can unlock new use cases beyond traditional data centers.
Those are solid points, but from a CFO's perspective, I have to ask, how real are these risks in terms of disrupting NVIDIA's growth? Supply chain issues can cascade quickly, and geopolitical tensions could restrict access to critical markets or components. Also, how does NVIDIA plan to balance these growth investments with the capital discipline investors expect? We've seen tech companies overextend on hype and then face margin pressure.
That's a fair challenge, Raj. Strategically, NVIDIA's leadership seems to be navigating these risks by diversifying supplier relationships to mitigate fabrication bottlenecks and investing heavily in in-house R&D to maintain technological differentiation. On the regulatory front, they're actively engaging policymakers and building compliant architectures. From a growth standpoint, focusing on high-margin AI and automotive segments allows them to sustain profitability while scaling. It's a classic risk-opportunity balancing act requiring disciplined execution.
Moreover, technological disruption is both a risk and an opportunity. While NVIDIA leads in GPU architectures for AI, emerging paradigms like neuromorphic computing or alternative AI accelerators could challenge their dominance in the medium term. Competitor advances in chip design and software ecosystems are accelerating, meaning NVIDIA must continue innovating aggressively to stay ahead. Yet, their entrenched software stack and developer ecosystem provide a significant moat if leveraged properly.
Exactly. And from my viewpoint, the biggest risk might be execution. Scaling these opportunities without diluting focus or burning through cash reserves. Strategic risks include not just external threats, but also internal capital allocation decisions, managing R&D intensity, and supply chain agility under volatile macro conditions. Investors should watch NVIDIA's ability to navigate this complex environment carefully, balancing bold innovation with prudent financial management.
When we position NVIDIA within the semiconductor and AI industries, their competitive moat is quite pronounced. NVIDIA currently holds approximately 70% market share in discrete GPUs for AI workloads, which dwarfs AMD's roughly 20% and Intel's nascent AI accelerator presence. This dominance is reinforced by their integrated software ecosystem, including CUDA, which is a significant barrier to entry for competitors.
That's a strong position, no doubt, but I'm skeptical about how sustainable it is. AMD and Intel have deep pockets and are aggressively ramping up their AI and GPU capabilities. Intel, for example, has announced substantial investments in AI chips and is leveraging its foundry scale, while AMD is bundling CPUs and GPUs for data center customers, which could chip away at NVIDIA's share if executed well.
Raj, your point highlights the intensity of the competitive dynamics. NVIDIA's scale and software advantage create a high entry barrier, but the semiconductor industry's rapid innovation cycles mean that maintaining leadership requires constant investment. Their vertical integration, combining hardware and AI software stacks, is a differentiator few can match today, but competitors are closing the gap, especially in heterogeneous computing architectures.
Exactly. And emerging players focusing on alternative AI accelerators like neuromorphic chips or specialized tensor processors pose a potential medium-term threat. While these startups currently capture minimal market share, their technological innovation could disrupt NVIDIA's GPU-centric dominance if they scale effectively. However, NVIDIA's entrenched developer ecosystem and early mover advantage provide a substantial moat that's hard to replicate quickly.
From an investor and CFO perspective, I'd add that the real question is whether NVIDIA can maintain its innovation pace without compromising margins or cash flow. Increasing R&D intensity and the capital expenditure required for next-gen node fabrication are hefty challenges. If AMD or Intel leverage economies of scale or forge stronger partnerships, NVIDIA might face margin pressure despite its current leadership.
That's the crux of it. NVIDIA's strategic positioning is strong, especially as AI demand accelerates globally. But their leadership depends on executing a multi-pronged approach, sustaining technological innovation, deepening ecosystem lock-in, and mitigating supply chain risks. They need to anticipate competitor moves while capitalizing on their premium positioning to defend and extend their market share. The next several quarters will be critical in confirming whether this leadership is sustainable. To wrap up, NVIDIA's latest quarter reinforces its position as a market leader, with robust financial health, driven by 35% year-over-year revenue growth, expanding margins up to 66.5% gross, and strong cash flow generation. Their strategic pivot toward AI and data center workloads marks a fundamental regime shift, supporting higher profitability and a durable competitive moat. However, working capital nuances and supply chain complexities require vigilant operational management. For investors and strategists, NVIDIA exemplifies a premium growth story underpinned by disciplined execution and technology leadership.
I agree with that, Shekhar, but the practical reality for investors is that this isn't a risk-free runway. Macro headwinds, geopolitical tensions, and intensifying competition from AMD and Intel could disrupt growth momentum. Inventory management and margin sustainability will be critical watchpoints. My advice would be to stay engaged but cautious. Look for consistent execution on R&D and supply chain resilience, and be ready for volatility as the semiconductor landscape evolves rapidly.
Absolutely, Raj. The key strategic takeaway is that NVIDIA's long-term value hinges on balancing bold innovation with operational discipline. Their leadership in AI accelerators and ecosystem integration positions them well to capture significant growth, but this must be matched with agile risk management and capital efficiency. For decision-makers, the focus should be on sustaining technological differentiation while proactively navigating regulatory and supply challenges. This dual focus will be the cornerstone of their continued market dominance.